Hello, good afternoon, everyone. Thank you for joining us here today. My name is 𝐓𝐡𝐞. I'm from the iFAST Research and Portfolio Management team. So I'm glad to be here to be able to share some of my insights on the global markets. So when most people, when they talk about investments, they tend to focus on the US market only. I think it's quite understandable, given that the US has been a dominant force in global markets for a very long time. But right now, so far this year, we are starting to see that US leadership is getting challenged. So with President Trump's return, the rising trade and geopolitical tensions, things are looking less certain. And at the same time, we are seeing a big shift in terms of how markets are behaving this year. Correlations between US and non-US stocks, they have dropped sharply this year. What that implies is that markets, they are no longer all moving into the same direction. So this makes portfolio diversification even more important than ever. I'm sure that previous speakers before me have also spoken about the importance of diversification. So where to diversify? I think this will bring me to a market that we feel is often overlooked. As you can probably already tell from my presentation title, that market I'm referring to is Japan. We think Japan hasn't gotten as much attention, but right now it is one of the most compelling long-term investment opportunities. So I think today's topic on Japan is very timely, and sometimes one of the best investment opportunities, they are just lying there in plain sight. So earlier this year on FSMOne, I wrote about Japan's small cap segment. So in particular, how this segment can provide diversification and the potential for attractive returns. At that time, many of these smaller companies, they were trading at very cheap valuations, even though their business fundamentals look quite resilient. But what really caught my attention at that time was that things were starting to shift. With corporate governance reforms picking up in Japan and long-term tailwinds coming into play, I believe that these smaller companies could start to see a re-rating. So if we fast forward to today, 6 months later, that thesis is starting to play out already. So against the volatility that we've seen this year, Japan's stock market has held up okay. The TOPIX and the Nikkei, these are key benchmarks for the Japanese equity market. They have delivered positive returns. But what is even more interesting is that the small cap segment, even though they have been less talked about by investors, it has been quietly outperforming the broader equity market. So to give you some numbers on the chart here, the MSCI Japan Small Cap Index has gained by almost 9% in Sing dollars just this year, which is quite similar to the returns you will get from China this year. So even against this volatility and uncertainty in the market, it seems like Japan is able to provide some pockets of resilience. So today, I'm going to break down what is driving this performance, what makes this time different for Japan, and more importantly, how investors like you are able to tap into the opportunities that are lying ahead. So perhaps let's start with the big picture first. What exactly is happening in Japan? After decades of sluggish growth, deflation, Japan seems to be turning a corner. To be clear, I'm not talking about a booming economy in Japan yet, but right now, the economic recovery seems to be a lot more sustainable. So this is being supported by strong business investment, resilient domestic consumption, and a sharp growth in terms of tourism. If you have traveled to Japan recently, then I think you will know what I mean. And at the same time, we are seeing stronger wage growth, and this is important because it likely suggests that inflation in Japan this time round is likely to stick. And speaking of inflation, we do also have to talk about interest rates. So after decades of ultra-loose monetary policy, including negative interest rates, the Bank of Japan is moving towards normalization. So the central bank has signaled the potential for even more rate hikes as long as the economic recovery continues. So all of this, we think it points towards a healthier and a more normal backdrop for the Japanese economy. While there are still some risks, such as the rising trade tensions with the US, we think that Japan is still in a much better position today as it was compared to decades ago. And this, we think, is a positive for the stock markets. Now, what about the Japanese yen? Historically, the yen has been weak. This is largely due to the wide interest rate gap between Japan as well as other major economies such as the US. So for example, when US rates are high, Japan's are low, investors, they will naturally move towards where they get higher returns. So that has been putting downward pressure on the yen historically. But good news today is that this gap is starting to narrow. As mentioned earlier, the Bank of Japan is normalizing monetary policy with rate hikes. On the other hand, US and other central banks, they are cutting rates. So this shift in terms of direction is helping to reduce the interest rate differential that has been weighing on the yen. So in other words, the Japanese yen is getting some room to breathe again, which is why you see the currency gaining very strongly against the US dollar in the last 1 year. And besides interest rates, there's also the geopolitical angle. During times of uncertainty, investors, they will invest in safe haven assets. And the yen is historically one of those safe havens. It's thanks to Japan's stability, its liquidity, and their strong external balance. And despite this recent yen appreciation, I do also want to highlight that Japan's real effective exchange rate, this basically measures how strong the yen is in comparison to other currencies adjusted for inflation. This indicator is still at its historical lows. But with Japan's economy normalizing, interest rates catching up with the rest of the world, we think that the yen could get even stronger from here on because it is so cheap. And what does a stronger yen mean for you as an investor? It can help to open up some investment opportunities, especially in domestically driven sectors that are not heavily reliant on imports. And more broadly speaking, when a country's currency is strengthening, it helps to boost confidence, not just for consumers and businesses, but also for foreign investors inside the stock market. Then this will lead me to Japan's small cap segment. But let's perhaps first understand what exactly are Japanese small caps. So as the name suggests, small caps, they refer to smaller size companies, usually with a market cap in the range of a few hundred billion yen. So we are not talking about companies that we'll find in the Nikkei. Instead, we are talking about companies that are less well-known internationally. And unlike the export-driven nature of many large companies in Japan, smaller companies, they are more domestically focused, which means that they tend to benefit directly when the local economy improves. So as you can see from the chart on the screen here, the majority of smaller companies in Japan, they derive all of their revenue within the country. And such companies, they often fly under the radar because they don't receive as much attention as the larger companies. But this is where we think the opportunity will lie. And from an investment portfolio standpoint, we think Japanese smaller companies, they are able to provide both diversification and the potential for attractive returns. So why are we so excited about small cap stocks in Japan, aside from the fact that they are domestically focused? So as mentioned earlier, Japan's economy is undergoing through some big changes. After decades, it seems like inflation is here to stay. And coupled with a tight job market, we are going to see a structural rise in terms of real wages. So what that means is that people in Japan could have more money to spend. And that is good news for smaller companies because they tend to benefit directly when consumers spend more. And on top of that, as mentioned, the yen is on a road to recovery. So this is another plus point for smaller companies because many of them, they tend to be very reliant on imported materials. So when the yen gets stronger, the cost of imported materials will go down. This overall will also help to boost the profits of smaller companies. Now, let me ask you a question. When you hear the term small caps, what do you normally think about? I think there's this common perception that small caps, they tend to be risky. Maybe they are companies burdened by debt. Maybe they are financially unstable. But when it comes to Japan small caps, you can pretty much forget about this stereotype because Japanese small caps, they are a notable exception. Many of them have surprisingly strong balance sheets, and this is thanks to years of conservative financial management. So to give you some numbers, about 60% of non-financial smaller companies in Japan have net cash positions. So net cash means that the company has more cash than debt. That is a percentage that is a lot higher compared to other developed markets. So if you compare that to the US, only about 40% of non-financial companies inside Russell 2000, which is a measure of US small caps, have net cash positions. So you can see that comparatively, Japanese small caps are financially stronger. And against the backdrop of rising interest rates, having little to no debt is often a big advantage. So why do I say so? Because this means that the companies, they are less exposed to higher borrowing costs. They don't have to worry about having to refinance any expensive loans. And with those healthy cash reserves, they do have the flexibility. They can choose to reinvest into growth. They can ramp up their capital expenditure. They can pay out more dividends. They can buy back more shares. So all of this are a positive for shareholders. On top of that, Japan's push for corporate governance reforms is also starting to make a real difference, even for smaller companies. There's the Tokyo Stock Exchange, which has been pressing companies to disclose plans to improve their capital efficiency and disclosure. So their method includes publicly highlighting companies that are not doing anything to improve their capital efficiency. And this strategy of naming and shaming has proven to be very effective in Japan's corporate culture, where a company's reputation really matters. So overall, when we talk about Japan's small caps, we are not just talking about a group of risky and volatile companies. We are talking about a group of companies that are cash-rich, they are increasingly well-governed, and they are also positioned to deliver long-term growth. And when we look at Japan's small caps, there's also a clear trend that we actually like, which is that return on equity, or ROE in short, it is on the rise. So ROE basically tells us how well a company is using its money to make a profit. So far, the numbers for Japan small caps are looking good. According to the MSCI Japan Small Cap Index, ROE is expected to increase from around 7% today to over 8% by the year 2027. Now, that may not sound like much, but it's actually a very strong signal that smaller companies in Japan, they are getting more profitable and they're getting more efficient. And why does that matter for you as an investor? Because when ROE increases, it often leads to what we call multiple expansion. That means that investors will be willing to pay a higher price for every dollar of a company's earnings. And this is also one of the key ingredients for share prices to go up over time. Now let's talk about valuations. Right now, we think that the valuations of Japan small caps are looking attractive. In fact, close to half of them, they have a PB ratio of below 1. This means that their current net value is below the value of their net assets. It's a sign that markets may be underestimating their true potential. And what we find even more interesting is the widening valuation gap between large and small caps in Japan. So Japan's larger companies, the ones that you will find inside the Nikkei 225, they have seen their valuations rise alongside stronger financial performance and also greater attention from global investors. But smaller companies haven't really kept up in terms of expanding valuations yet, even though they are also riding on similar positive trends that can lead to stronger growth moving forward. So as a result, currently, Japan small caps, as you can see over here, is trading at a 28% discount as compared to larger companies. And to put that into perspective, the historical discount in the last 10 years was only about 15%. So in other words, currently, Japan small caps are trading at close to double the discount as compared to historical levels. And when we zoom out and compare Japan small caps against their global peers, we are also seeing a similar story. So currently, Japan's small caps are trading at a discount compared to its historical average. If you compare that to developed markets, it seems like a bargain. For example, the Russell 2000 in the US is currently trading at a premium. So overall, Japan's smaller companies, they not only have resilient fundamentals and promising earnings growth, they are also undervalued. So if we apply a reasonable PE ratio to our projected 2027 earnings for the smaller companies in Japan, our estimates, they suggest that small cap stocks in the Japanese equity market could rise by over 30% in the next 2 years. So right now, we think now is a good time to really take a closer look at the smaller companies in the Japan market. So as mentioned previously, unlike large caps, smaller companies, they don't usually get as much attention from the market and also even from analysts. In fact, on average, less than one sell-side analyst covers Japanese stocks with a market cap between 10 to 200 billion yen. So this means that the small cap universe is actually one of the most inefficiently priced areas of the Japan market. And we think this is where active managers, they have the chance to uncover any hidden gems. And one fund that we like in this space is the Janus Henderson Horizon Japanese Smaller Companies Fund. So from a wide universe of small cap stocks, this fund, the investment team of this fund, they will pick out their top 50 best ideas to invest in. And they dig very deep. They don't just look at the numbers, they will speak to the company management before investing into their stocks. And also, today is ETF Festival. If you prefer a passive approach, you can also consider ETFs such as the iShares MACI Japan ETF, Japan Small Cap ETF. And if you're looking for something a little bit more balanced, here is another fund that you can consider. It is called the Eastspring Investments Japan Dynamic. So it will give you access to both large and small companies inside the Japanese market. It has a value-driven approach, which means that the investment team is always on the hunt for companies that are cheaply priced. So the fund currently leans towards sectors like industrials, domestic plays, and defensives. These are typically areas that are more tied to Japan's economic recovery, and they are also less exposed to global market conditions. And even though the fund is diversified across company sizes, it does have a strong tilt towards smaller companies. In fact, about 40% of the fund's allocation is in small and mid caps. So you get the best of both worlds in just one single fund. You get the growth potential of smaller companies, and you also get the stability of the larger and the more established names. So overall, my key takeaway for you today is really that we feel that the Japan market has been overlooked. In fact, the small cap segment has been quietly outperforming the broader equity market. This rally may be under the radar for now, but we think that as the structural reforms continue to accelerate and valuation gaps start to close, more investors could start to take notice and jump in. So if you're looking for new investment opportunities, feel free to consider this lesser-known part of the Japanese equity market that we think can offer meaningful growth potential, and they can also be a good addition to a well-diversified portfolio. So that's all I have for today. Thank you for your kind attention.
Awesome. Thank you, Hui Shi.